Good afternoon everyone and welcome to the James Cooper Creston webinar on the topic of UK Patent Box. Today I am joined by Margaret Savory, one of our tax directors here at James Cooper Creston, and she specialises in innovative tax reliefs. This is the second part of our tax webinar series, following on from our one on R&D tax credits last week. You should have the ability to ask any questions that you have on your screen. Margaret will deal with these towards the end of the webinar. Without further ado, I'll pass over to Margaret to take you through the slides today.
Hello. I'm going to talk today about the Patent Box rules and the recent changes to the legislation which came into force on the 1st of July 2016. This is the proposed agenda for today's webinar. I have included more detailed slides in the pack, and we have a very busy agenda. There is lots to look at with Patent Box, so I may not expand on them in detail, but I've put them in for completeness so you could look at them at your leisure when you review the slides. So first of all, I'll start with a quick overview. Then I will talk about the old rules. Now, the old rules, it's a bit of a misnomer because, as we shall see, the new rules that come into place still incorporate all the old rules, and they will still be in place in their entirety until 2021. Patent Box came into effect in 2013, and then the old rules run potentially until July 2021. We'll then look at the new rules, and as I said, these were introduced in July 2016, and from July 2021 everyone will follow the new rules, which are basically the old rules with modifications, as we shall see. Because the old rules and the new rules potentially can run in parallel through the period from the 1st of July 2016 until July 2021, there are transition rules, and we'll talk about them, what happens in this current period until 2021, and then a few practical thoughts at the end, observations from what I've already seen in having undertaken Patent Box claims for clients over the last few years. So without further ado, we'll move into a quick overview of the Patent Box. Basically, it's to encourage, give a tax incentive to those that innovate and those that capitalise and make profits from their innovations, and it's considered a complement tax incentive to the very popular R&D tax relief. As I mentioned before, it was introduced in April 2013. And the most available statistics for 2014-2015 suggest that 700 Patent Box elections were made. In contrast, 22,500 R&D claims were made. So it has a little way to go in terms of popularity. And also, I think, because it is, as the name suggests, a Patent Box, maybe not as many people will ever claim it. So as I said, it's a reduced rate, 10% of corporation tax for profits derived from patents. So the key thing to note is it's for profits. If you're loss making, probably Patent Box is something not necessarily to consider immediately, but it is something definitely to have on your radar if you're anticipating profits down the line. The value of a Patent Box is actually decreasing because the mainstream corporation tax rate is decreasing. 19% currently, but by April 2020 the mainstream rate will reduce to 17%. So on the face of it, Patent Box sounds very simple, just 10% for my profits, but how do I actually calculate what is in the box? The original legislation ran to 40 pages of legislation. The modifications that were introduced in July 2016 ran to a further 30 pages. So that is 70 pages of legislation in total. So there are lots of bells and whistles to the Patent Box. There's a lot of detail. Obviously, I can't go into it all now. I'm just trying to give you a flavour of what the changes are and what the basic rules are. So we have some qualifying conditions, and I'll drill down onto those. These qualifying conditions are the same for the old and new rules. And then once ensured that you do qualify for Patent Box, there are the calculations, which are quite complex. Broadly 3 steps for the old rules, and then an add-in new step that is being introduced for the new rules. and I'll talk more about that later. And broadly, this additional step links the underlying R&D that you do to develop your patent or your item containing the product and the patents themselves. So it's a new linking step that needs to be introduced. So, without further ado, moving on to the old rules, which, as I say, it's really all rules because they will still continue to apply, particularly with regard to the qualifying conditions for the new rules as well. So the first thing is you have to be a company, you must be within the scope of corporation tax. So this is not relevant for sole traders or partnerships unless you're in a corporate partner, corporate member situation. It is an election and you have to make an election in writing to HMRC. It is a per company election. So your company makes one-off election, then the company in its entirety is elected into the patent box. It is not a per patent election. And once you've made that election once, you will continue being in the patent box forevermore until you decide to come out. As I say there, you can come out at any time, but you won't be allowed back into the patent box for another 5 years. This is to stop people cherry-picking good years and not being in the bad patent box for not such good years. How long have you got to elect into the patent box? Well, it's normally 2 years after the end of your accounting period, or as the legislation says there, 1 year after the first accounting period. So it's effectively 2-year deadline. So if you have a year ended 30th of July 2016, you could elect into the patent box until 31st of July 2018. In terms of qualifying ownership and what's qualifying conditions, you have to satisfy qualifying ownership, which is basically, as the name suggests, you have to own a patent. And you have to own a patent granted with either the UK Intellectual Property Office or the European Patent Office, or there is a separate list of 15 or so other individual European countries. We list the IP types there. Obviously it's patents, or it can be that you've developed yourself or applied for the patent, or it may be patents that you've acquired. Certain sectors don't have patents, so included in the legislation is the equivalent to patents in those particular sectors. If you license in a patent, so you don't own the underlying patent, but license it in and then work on it, there are detailed rules, but it must be a territorial exclusive license. Patent pending does count. So if you are developing your own patent, the patent pending period does count. And how it actually mechanistically works is at the point the patent is granted, you can look back over the patent pending period for up to 6 years to bring in the benefit of those patent box profits in the earlier years. But one thing that does indicate that even in the patent pending period, you might need to collect the appropriate data. In terms of the ownership of IP, there are additional qualifying requirements because the government wants to incentivize companies that actively innovate and develop. It's not about passive ownership of IP. So in addition to owning the patent, you must undertake some form of qualifying development, or if in a group situation, another member of the group. You either must develop the patent itself, or if you have a patent that you've not necessarily developed, you must be developing the item incorporating it. For example, you can think of a situation where you might have a license to develop a non-stick coating. You get an exclusive license, you then develop the frying pan range using that non-stick coating. And as I said there, just acquiring and marketing a developed patent is not enough to qualify for the box. There must be some developments of innovation. Just a word of warning, here's a little bell and whistle on complexity. If you are buying a company or buying some trade and assets, if there's a change of ownership, you must continue that development activity after the change of ownership of the IP. A few additional rules if you're in a group of companies. There is an additional test known as the active ownership condition, which is if you are not the company that's actively developing the patent, you must demonstrate that you are actively managing the patent. So situations where there is an IP holding company, you must demonstrate that you strategically consider why you're holding this patent, actively make decisions around it to exploit the IP. There's a word of warning with IP holding companies, as we will see, because as I've alluded to, under the new rules, you have to link the R&D work to the underlying patent. So an IP holding company under the new rules may not qualify. So that is something to consider if you have IP holding companies. You may need to consider restructuring if you think you might come under the new rules. We'll talk about the new rules more later. Having satisfied ourselves that we qualify, we then need to look at the calculation. And the key thing about the patent box is it works from a principle of everything in the box at the beginning, and then you start stripping items out. On the next slide, I indicate the various heads of income. And so basically, if you sell an item with a patent in, all the worldwide income from the sale of that product can be included in the patent box. The example that was used in government was if you had a BMW that we were selling, and this BMW had just a patent on its windscreen wiper, say. So indeed, the sales, entire sales of all your BMW would count under head 1 there as worldwide income from sales of the patented product, even though there was only one tiny component that is patented. Other things that are included in the box, if you license out, so to get someone else to develop the patent further, those license fees are included. And then the last 3 are to do with really infringement rights. By far the biggest will be under head 1. So these are the income that goes into the box. If we now go back to the calculation, the calculation talks about working out the turnover from those patents, so thinking about our sales of the BMW. What we then do, we've worked out the income that's in the box. What we have to do then is work out what profits go in the box. There are 2 methodologies under the old rules, what's known as the proportionate or formulaic, where you just basically prorate the income. So if 80% of my income went in the patent box, 80% of my profits, my taxable profits, would go in the patent box. That's the easier way. The streaming approach, now again, this is going to be mandatory when we come under the new rules. There will only be the streaming approach. But the streaming approach is basically looking at it in more detail. So whereas your income may go into the box at 80-20, your profits might have a different split. So it's actually you making mini little profit and loss accounts for that patented product to identify the real product. And it might be that your patented products or items containing patents have a higher margin, so streaming may give you a better result. As I mentioned, streaming will be the only route available under the new rules. Having identified what is your RIPI, and as you can see there, I've highlighted in bold some acronyms because the legislation is full of jargon. So that step 1, you end up with your relevant IP income, the RIPI, what income goes in the box, what profits, initial profits go in the box. There are then some detailed rules to strip out a few items because we've put all this income in the box from the sale of our BMW, but what you have to do is then remove what's called the routine profit. And the argument to this is that you would make a profit on selling a BMW anyway, regardless of whether it had a patented windscreen wiper or not. And so it's procedural, it's set out in the law. You basically deduct a markup of 10% on routine costs like admin, staffing, that sort of thing. You just strip it off. Because what they're trying to do is get the pure additional profit that is a result of the patent. Having done that, you're left with a qualifying residual profit. They then say, well, hang on a minute, a lot of the value of the profit will be not because of this patented windscreen wiper, say, it's because it's the BMW that people are buying. So we then need to strip out an element for brand. So what element of profits are because it's a BMW you're buying, not just a car with a patented windscreen. So you have to do typically a transfer pricing analysis to work out what the arm's length value of the brand is. Strip that out and you're left with the relevant IP profits, which in plain speak is your patent box profits. Under the old rules, broadly that's what's applied at 10%. Under the new rules, you have this extra step of applying an excess fraction. So that, in a nutshell, is the calculation. The next couple of slides I just mentioned, and they're for reference only, a little bit more about the formulaic versus streaming approach. Remember, it is the streaming approach that will continue on into the new rules. And you may indeed, as we will see, require multiple substreams with the new rules if you have lots of products. I've also got a little numerical example, just again making the point that potentially when you stream, you might have a better result. Again, something to look at your leisure. Because time marches on, we need to get onto the new rules. So far we summarised the old rules. Remember, those will still apply for the new rules. So the new rules came into force from the 1st of July 2016. And the context of that was that as a result of the OECD and G20 base erosion and profit shifting project, they looked at what they considered to be harmful tax practices, i.e. low tax, what they call preferential regimes. And the patent box was considered in its current state to fall into that, because they felt that there were situations where you could benefit from the patent box, this low rate of 10% in the UK, without actually developing the patent per se in the UK. You might have a subsidiary company in another country undertaking all the R&D work. So what they've done as a result of this OECD requirement, which has now been brought into UK legislation, is to look more at the substance and basically say, where are the substantial activities taking place for the patents? So let's look at where those activities relating to the patent, and if they're aligned, then you can benefit from the patent box. And what they've used is the R&D expenditure, and this is the R&D expenditure that is used for when you make an R&D claim. Qualifying R&D expenditure is basically used as the proxy for the activity. And so they're saying we need to modify our patent box calculation to take into account the link between the R&D work we do in the UK and the development of the patent. And this was introduced from July 2016. Before we look at the detail of this extra step, let's just have a look at whether we're in the old or the new rules. And there is still time, because of the 2-year election window, to elect under the old rules. But you need to know, can I still be in under the old? So the first question you ask yourself is, when is my accounting period? So if I have an accounting period beginning after the 30th of June 2016, and that's my first time I elect into the patent box, I will follow the new rules. So if I elect into the patent box for any accounting periods beginning after the 30th of June, you only have to consider the new rules. If you have an accounting period beginning prior to the 1st of July, say an accounting period beginning on the 1st of January 2016, say, you then have to ask yourself the question, when did I create my patent? And that can include patent pending. When did I put my patent application in? If it is prior to the 1st of July, for that particular patent or products incorporating the patent, I can follow the old rules. Because I elect into the box, and I can elect in under the old rules because my accounting period started prior to 1st of July. However, if I had a new piece of a new patent that I created post 1 July 2016, I would have to follow the new rules. It does get complex. And just to remind you there, the old rules will disappear after July 2021 and everyone will have to follow the new rules. So what is this step for the new rules? Now this is the slide to actually star because I feel this is the most useful summary slide to remember. And thanks to the HMRC who developed this flowchart. So on the left-hand side, you've basically got the old rules. There's 3 steps there to arrive at your RIP. And under the old rules, you would basically calculate your patent box profit on that. In parallel with that, what you have to do is the right hand, which is basically track your R&D to your various products or product suites. And this is where you have to start thinking about data collection, tracking and tracing, the R&D expenditure to your various products or patents, to then calculate what is known as the R&D fraction. And this is the extra step that you then, having calculated this R&D fraction, and we'll talk about that in the next slide, you multiply whatever the R&D fraction is by whatever that relevant IP profit is to come up with this revised Nexus product. And sometimes the fraction will be 1/1, as we shall see, so there'll be no effect. But sometimes it can reduce the amount of profits that will go in the patent box. And then finally you get your patent box profit, which you would then tax effectively at 10%. The next slide details the R&D fraction. So the R&D fraction can never be greater than 1. And basically what it's doing is restricting situations where you might have subcontracted out your R&D to a sister or a related party company. So what goes in at the top? D is your direct in-house R&D costs incurred on producing or developing the IP. S is the costs of R&D subcontracted to third parties. So it's okay if you subcontract some element out of your R&D, as the R&D rules allow, but that's to a third party company. That's on the top. What hits is if you subcontract, and that's where you can see on the denominator along the bottom there, you've got the D and the S, and if that's all you're doing, you'll end up with a fraction of 1. However, if you acquire IP, or if you subcontract to connected parties within your group, another group company, potentially that can reduce the R&D fraction. You can see there is a little uplift there, so it helps. That uplift will be used to make up a shortfall, but it will never take you above 1. But there are circumstances where you might, as a result of subcontracting out to connected parties, have a fraction that is below 1. There may be lots of circumstances where people go, you know what, we do all our in-house R&D ourselves, so it's going to be 1/1. It will have no effect on us. However, you just need to be warned, this is cumulative data. The data is collected cumulatively and for up to 20 years. So every year you will add to this. And even though you know you're 1/1, you will still need to collect the data to demonstrate, yes, we are 1 divided by 1. And you will have to do this for up to 20 years. So every year you will need to keep the historical record of what the R&D fraction was the year before and add to it. However, as I say, lots of companies will be unaffected. Okay, so the challenge is to collect the amount of data. So as I put there, tracking and tracing, you will have to start thinking about data in a way you haven't done before if you were under the old rules, because you will need to map either your income to the right product for streaming or map the R&D expenditure to arrive at the R&D fraction. HMRC are pragmatic and let companies decide how to keep the records, the granularity of the records. It might be you want to substream by patent or by product. When do you need to start gathering the data? Well, if you're a new entrant, so you are under the new rules now from 1st of July 2016 potentially, they say they would like you to gather the data from 1st of July 2013. So you need to be perhaps going back to see if I can gather this data beforehand to map my R&D expenditure to the IP. If you can't really gather the data, they will accept you'll start from July 2016. If it's in your best interest, you can elect to go back to give you a better fraction results to go back up to 20 years. Even if you're thinking, well, it doesn't affect me, I'm under the old rules, I'm not going to pop out of the old rules till 2021, the expectation is when you pop out of the old rules into the new rules in 2021, you will have gathered the data since July 2016. So you need to start thinking about gathering the data now. There are elections in place. If it's very simple, one product, one patent entity, you can make some elections, but you still need to be aware of what data you can link to your underlying R&D rule. Again, this is a summary slide for you to look at your leisure, but it's just showing the effect of the R&D fraction can potentially have. You've got some products, each incorporating different patents. If they were all under the old rules, you would just take the full RIP of 9,600 on the right-hand side there. Here, because you've got different suites of products, A, B, C, D, you have to look at the R&D, map the R&D for each one, following the formula, so you'll get a different result for each one. In some cases, you'll have an R&D fraction of 1, in some, a different R&D fraction. Multiply the two numbers together to come up with a total. And as this is all, the R&D is all a side calculation, the same bit of R&D may feature in several different R&D fractions because you're just trying to work out how the R&D links to the patent. So that is a flavour of the new rules very briefly because I realise we're pushed for time. Moving on to transition. Where are we now? We're in 2017. So potentially there are people working under the old rules and you can still elect into the old rules. That is obviously closed to new entrants post 1 July 2016. You might have people under the new rules. You might have people operating under both. So it can get complex. Firstly, just the reminder, I've told you 2-year time limit for electing under the old rules, and I've given an example there. What I want to talk about is how complex it might get in the transition period, and we're basically in the transition period until July 2021. There are lots of permutations. So what I have here is two companies, Company A and Company B. Company A has patent 1 which maps into product 1. Now Company A had a qualifying patent and elected into the box pre-July 2016, so it's under the old rules. Company B, in contrast, second patent, didn't have a qualifying patent until after July, and its first accounting period was after July, so it had to elect in under the new rules. So that's straightforward. And of course, Company A would automatically pop out into the new rules in 2021. However, life doesn't stand still. What if in this 5-year period, Company A carries on developing and develops a new patent and a new product? Now that patent came online post 1st of July. Now it elected in under the old rules, but for the income stream for this new product, that will come in under the old rules. And you'll have to probably have a separate stream where you're under the old rules for product 1, but product 3 that you're now developing, you'll have to map that data and come in under the new rules. What happens if you develop patent 4 in the period? And all this does is modify product 1, but not much, it just adds into product 1. So again, that patent came online post 1 July, but product 1 we're doing under the old rules. So probably you can argue it's the same rules, so that will carry on under the old rules. But what then if you have a real upgrade to product 1 to make it product 1.1 with a new patent, patent 5? Is that under the old rules or the new rules? Well, it depends. And the next slide talks about the work you have to do in that circumstance where you perhaps have modified an old product that was under the old rules, but you've modified it now in this transition period. Do I bring it into account under the old news or new rules? And basically what you have to do is test every time you add new IP income to this substream, and there are 2 alternative methods given. And basically they say, looking at it from a sort of value of item basic, have I significantly improved the value of the item, and is that more attributable to what I've just recently done or the old existing IP? And if it's wholly or mainly new, it will be under the new rules, or wholly or mainly old, under the old rules. Or you can do it more in just adding up your IP rights and look at the IP rights, and basically it's an 80-20 rule. So if more of your IP rights are new, 80%, you'll treat as new. If it's more than 80% old, you'll treat as old. And if it's that bit in the middle, you'll have to do some sort of apportionment exercise. Again, you can see how it gets complex. HMRC, I think, will have to be pragmatic under these new rules as long as you've developed a methodology. Finally, just to think of a few practical thoughts, I think probably what's come clear from this presentation is that you need to know, if you're in under the old rules, you will need knowledge of both old and new rules, and the new rules are based under, or mainly, initially the qualifying conditions under the old rules. And just because you're under the old rules, you can't be blind to the new rules. What is going to be important is data collection, thinking about how you're going to stream your income streams, and think about how you're going to map your expenditure on R&D to substreams, even if you're a simple company where you know you do your R&D in-house. You will need to at least document that. A word of warning, because it's cumulative, remember those 20 years, you might need to have some R&D activity, because HMRC have confirmed that if you have zero R&D to map to a long-standing patent, zero cumulative R&D activity on the top and bottom, that will count as zero. You want to have a 1 in there to multiply it by your R&D, your patent box profits. We've talked about the deadline for the election. There is still time to check and see if I can qualify into the old rules. If you have a very simple situation, you might go, you know what, I can have 5 years of being under the old rules. It is simpler. Groups, I mentioned the word of warning. If you have an IP holding company, you might want to think of the impact on the new rules. And you might also want to think about your supply chain. If you are in a group and you do subcontract to a connected group company, maybe and they subcontract in turn out to a third party, you might want to think about subcontracting directly yourself. In addition, you just need to be aware of transactions where you acquire IP, as this could affect your R&D traction. Just on this last slide, I've just given you a few connections as to where you can get further assistance from HMRC. The rules are complex, communication is key, you'll need to talk to your patent attorneys, tax advisors, finance function, and work collectively together. HMRC specialists are based out of the Innovation and Relief, Incentives and Reliefs team, which deal with patent box, R&D and other innovative reliefs. And they are very happy to discuss things with you. There is now detailed guidance on the new rules as well as the old rules in the HMRC manuals, and I've given you the reference there. As I said, the rules are complex, but I hope this has given you a flavour, at least in an overview in just slightly over 30 minutes. If you have any questions, I'll be delighted to answer them. There are my details up on the screen now. So thank you very much for your attendance at this webinar.